Every personal finance platform on the internet will tell you the same thing. Cut the housekeeper. Cancel the meal delivery. Stop paying someone else to do what you can do yourself. That advice is engineered for someone who has never carried a director-level title, managed 3 direct reports before 8 a.m., and still had to confirm the nanny's schedule from a conference room in Dallas. The mainstream framework treats outsourcing as indulgence. But here's the structural reality: nobody is calculating for you. The female executive who earns $180,000 a year is not paying for convenience. She is paying for operational continuity. She is funding the invisible infrastructure that keeps her performing at the level her compensation demands. And that infrastructure has a price tag, a specific one. For most women at the senior manager to VP level in major U.S. metro markets, it runs between $48,000 and $54,000 annually. Not in lifestyle inflation, in executive maintenance. The non-negotiable operational cost of being a high-performing woman in a corporate system that was not architecturally designed for her. That number is what we're dissecting today. Let's break down exactly where that $50,000 goes, because it doesn't show up as one clean line item. It arrives quietly, distributed across categories that the personal finance industry has collectively decided to call frivolous. Full-time or part-time childcare in metro markets averages $28,000 to $36,000 per year. Executive health optimization, the functional medicine appointments, the therapist who understands C-suite pressure, the nutritionist managing the cortisol damage from 60-hour work weeks, adds another $6,000 to $9,000 annually. Professional wardrobe maintenance, alterations, and the quiet but very real expectation that senior women present immaculately averages $4,000 to $6,000 per year. Household management services, the cleaning, the grocery logistics, the administrative outsourcing of domestic decision-making runs $6,000 to $9,600 annually at the standard market rate. Add the mental load management tools, the premium calendaring, the organizational systems, and you are precisely at 50. My eyes. Here is what makes this a systemic trap, not a personal failing. Your male counterpart at the equivalent director level is not carrying this operational overhead. Research from the Harvard Kennedy School and McKinsey's Women in the Workplace data consistently shows that male executives at equivalent compensation tiers spend approximately $8,000 to $12,000 annually on comparable personal maintenance categories. She is spending 4 to 5 times that amount just to maintain parity on the performance floor. That's not a lifestyle gap, that's a structural tax. And cruelest design feature of this trap? She is paying it from post-tax income. Every dollar of that $50,000 operational stack has already been processed through her federal marginal rate, her state income tax, her FICA contributions. At a $180,000 W-2 salary in California, her effective combined tax burden sits at approximately 38 to 40%, which means she had to earn roughly $83,000 in gross income to fund $50,000 worth of operational survival infrastructure. Stop. Let that sit for a moment. She is generating $83,000 of gross labor value annually just to stay competitive in a system that doesn't formally recognize this cost exists. This is the precise moment where the guilt gets weaponized against her. The personal finance ecosystem has no framework for this reality. Its default solution, optimize your spending, cut non-essentials, treats the $28,000 childcare bill as a discretionary variable. It is not. Removing that variable doesn't free up capital, it collapses her availability, her cognitive bandwidth, and ultimately, her income-generating capacity. Cutting the infrastructure doesn't reduce the expense. It transfers it back into her own time at a rate her billable hours cannot absorb. This is the liquidity trap, hiding inside the wellness budget. And the psychological pressure compounding this financial structure is not accidental. There exists an unspoken corporate double standard with documented behavioral data behind it. A 2023 Yale School of Management study confirmed that female executives are evaluated more harshly on presentation, composure, and executive presence than male peers at identical performance metrics. The styling budget is not vanity. It is a compliance cost. It is the price of being taken seriously in rooms that were not built with her authority in mind. She is funding the perception of her own credibility. With after-tax dollars, with no deduction, no recognition, and a side serving of guilt from a financial media complex that has no framework for the operational economics of being her. Here is the systemic revelation this entire analysis has been building toward. The $50,000 executive maintenance tax is not a spending problem. It is a capital allocation problem. And the distinction between those two diagnoses determines whether this cost extracts wealth from her or builds it. Call it the operational ROI reframe. Every line item in the executive maintenance stack needs to be evaluated not through a lifestyle lens, but through a performance leverage lens. The question is not, can I afford this? The question is, what is the documented return on this expenditure against my income generating capacity? The nanny who covers the 7 a.m. call frees 3 hours of peak cognitive performance weekly. At $180,000 annually, her hourly productive value is approximately $87. Over 50 weeks, those 3 hours weekly represent $13,050 in protected income generating capacity. The $28,000 childcare cost is funding a documented $13,050 annual return in protected peak performance hours. That is a 46% ROI on operational infrastructure. No equity portfolio she holds is generating that on a consistent annualized basis. Now, the actionable reframe. If she owns or has meaningful grounds to establish a sole proprietor consulting structure or a single-member LLC alongside her W-2 employment, certain executive optimization expenses, professional development, home office allocation, technology infrastructure, and specific wellness costs directly tied to income performance become legitimately deductible business expenses under IRC Section 162. This is not aggressive tax positioning. This is the institutional tax architecture that male business owners have utilized for decades. The structural asymmetry exists. It is legal, and it is being systematically underutilized by high-earning women who have been conditioned to frame their operational costs as personal indulgence rather than capital deployment. The executive who shifts even $15,000 of her $50,000 maintenance stack into a legitimately structured business entity at her marginal federal rate of 32% saves $4,800 in federal tax liability annually. Compounded over a 10-year career trajectory at a conservative 7% investment return, that's a $66,239 swing in net asset accumulation from one structural reframe. Stop funding the system's inefficiency with your guilt. Start treating your operational infrastructure as the institutional investment it already is. But here's the compounding failure that most women at this income level never see coming. She optimizes her operational stack, protects her performance capacity, and then watches the largest single asset in her compensation package silently concentrate all of her financial risk into one catastrophic correlated position. The same corporate machine extracting the executive maintenance tax is simultaneously issuing her RSUs that tie her entire net worth to the continued goodwill of one employer, one stock price, and one board's quarterly mood. Click the video on your screen right now, and let's pull back the next layer to dissect how your director-level RSU package is quietly engineering a concentration risk exposure that a single restructuring announcement can permanently collapse.